This is going to be a homework walkthrough for Chapter 12 practice. So we're just going to talk through these. In each question, all of this data is the same. We're working for Cardinal companies. They're considering a 5-year project that would require a $2,955,000 investment in equipment with a useful life of 5 years and no salvage value. The company's discount rate is 18%. The project would provide net operating income in each of the 5 years as follows. And then they give us the sales, variable expenses, contribution margin, etc., down to the net operating income. And then if you want, you can refer to those exhibits for your discount factors in later problems. So question 1, which items in the income statement shown above will not affect cash flows? And this is where you click to check it, or you click again to leave the box empty. And so if you think about these things, which things, whether in the long term or the short term, affect cash flow, right? They're asking which one does not affect cash flow. And if you'll remember, sales, that definitely has to do with money. Variable expenses also, we pay money. Advertising and out-of-pocket expenses, we pay out money. So those all affect cash flows. The depreciation expense is just on the books. It is not a cash flow. And I think the reason they're pointing this out is that then in question 2, so for all of this, like I said, it's the same data. So I have taken and put all of the numbers that they gave for my problem down here so I can reference them. So question 2, they want to know the project's annual net cash inflow. Well, question 1, we just figured out depreciation does not affect cash flow, and net operating income has that subtracted out. So to get the annual net cash inflow, we simply take the net operating income and add back in the depreciation. So for mine, the annual net cash inflow is $1,100,000. Question 3, again, same information. What is the present value of the project's annual net cash inflow? So from question 2, mine is $1,100,000. And then we can get the discount factor from Appendix 12B, or if you'll recall that formula where it's 1 divided by 1 parentheses plus the discount rate. And if you anchor that cell, close parentheses, raised to the value of the year. And then I just do that for each consecutive year. That gives me those same numbers. But when I do this, I'm going to use the one that's hard input, and I'll show you why in a minute. So the present value is simply going to be equal to parentheses, the cash inflow times the discount factor, close parentheses, plus open parentheses. And I'm just going to reference that inflow each year. There's, I'm sure, easier ways to do this, but I'm going to do it 1 year at a time just so you can see what I'm doing. Oops. Okay. So that essentially was this multiplied by each year's discount factor and then added all together. I'm just going to show you something. So if I had done the PV formula, where it equals PV, the rate, the years, and the payment comes up with just a slightly, oh, whoops, I forgot to do negative PV. It comes up with just a slightly different number, and that's because of it's using all of the decimal places. I also think if I had added these discount factors together, and I could have just done the annual net cash inflow times the sum of all the discount factors, and that gets me the right answer. But if you look at this one, because this is the one where I did the, oh, whoops. So there's lots more decimals. Let's just try that out. Equals this times not the hard input, and it comes up with that same number from the PV formula. So for this question, in order to get the right answer, you've got to hard input those numbers or get them out of the appendix. But remember, on the exams, you do not have access to that appendix. So you're going to want to know this formula: 1 divided by parentheses 1 plus the rate, close parentheses, raised to the value of the year. Okay, question 4. What is the project's net present value? So if you remember, present value is just the value of the cash flow. Net present value, you take the in and outflow of cash. And so the now is a negative of the investment in the equipment. And that is just the total for now. And there is no discount factor because it's now. And so the present value of now is just that purchase of the machine. And then for the cash flow, if you'll recall, for mine in question 2, my cash inflow was 1,100,000. So 1, okay, and so that is my total, because there isn't anything else I need to worry about for this one. And then I just took those discount factors from the previous question and I added them together and then multiply 1 year's worth of cash flow times the total sum of the discount factors. And then net present value is going to be the sum of these two numbers. So my net present value is 484,700. So that's how I got that number. Okay. Question 5. What is the profitability index for this project? So remember, profitability index is the present value of cash inflows. And I have that from question 3, right? That was the answer to question 3. That's my present value of cash inflow. So I put that right there, divided by the investment required. So that's going to be the present value of cash inflows divided by the investment for the equipment. And round the answers to 2 decimal places. And this is just a number. It's not a percent or anything else. Profitability index is just a number. Okay. Now they want to know, what is the project's payback period? So remember, my net cash inflow from question 2 was 1,100,000. And so I just simply take the initial investment in equipment divided by the annual net cash inflow, and that gives me 2.69 years. Remember to round to 2 decimals. And again, this is years, so it's just the number. Okay. Question 7. What is this project's simple rate of return? So we need the annual incremental net operating income, which is what they gave us right there, divided by the initial investment. So equals net operating income divided by initial investment. And this one is a percent, and they want us to round to 2 decimal places. All right, question 8. If the company's discount rate was 20% instead of 18%, would you expect the project's net present value to be higher or lower or the same? So it would be lower because a 20% discount factor decreases your value of cash 2% more than an 18%. And so the money is 2% worth 2% less every year than if we had stayed at the 18%. Okay. If the equipment had a salvage value of 300,000 at the end of 5 years, would you expect the project's payback period to be higher, lower, or the same? It would be the same because payback period does not have anything to do with salvage value. That doesn't affect it. And if the equipment had a salvage value of 300,000 at the end of 5 years, would you expect the project's net present value to be higher, lower, or the same? It would be higher because remember that salvage value gets added back into your cash flow at the end of the 5 years. And so that would increase your net present value. If the equipment had the salvage value of 300,000 at the end of 5 years, would you expect the project's simple rate of return to be higher, lower, or the same? It would be higher because the salvage value would lower the annual depreciation expense by $60,000 in my question, which would raise the annual net operating income and the simple rate of return. So simple rate of return would be higher. Okay, now they're going to change things up on us. Assume the post audit showed that all estimates, including total sales, were exactly correct, except for the variable expense ratio, which actually turned out to be 45%. What was the project's actual net present value? Okay, so the first thing I did was I figured out what the previous variable expense ratio was by taking the variable expenses divided by sales. So it was, oh, shoot. It was 35%. And so sales, they said was exactly right. And again, these are the numbers that they gave me up here. But my variable expense is going to be different. It's going to be what they say, 45%. So I'm going to take sales times 0.45 to get the new variable, right? See, that was my previous variable expense, but now it's this. So then take contribution or sales minus variable equals contribution margin. And then I just need my fixed advertising and etc. I don't take into account depreciation right now because we're just talking about cash flow. So equals this minus 6. Okay, so now we're talking about net present value, so we have to take into account the purchase of the machine. So that's going to be a negative 2,955,000. And again, in the now column, that's all we have to take into account. And so the present value, there's no discount factor, that is the same. I took these discount factors from the previous question. So I'm just going to reference that right there. And then cash flows is for each year is now going to be 825,750. So that is my total cash flow. And then I multiply the total cash flows times the total of the 5 years of discount factor. And then I sum those numbers. And remember, if you get a negative number, to put it in as a negative. So for my question, negative 372,880. Okay, so payback period. Again, we're still dealing with the changes they made in question 12 with the new variable expense ratio. So I want to know what's the project's actual payback period. So from question 12, that new cash flow for me was 825,750. And this is my initial investment. And so payback is going to be equal to the initial investment divided by the annual net cash flow. So I get a payback period of 3.58 years. Okay. And we're keeping that same change of the 45% increase in variable expenses. And so I just plugged that in. So I took all of this data here because they want to know what's the simple rate of return. And for that, I need to know what my incremental net operating income is. And so I just plugged in that new variable expense from question 12, but all the rest of the numbers, the sales, advertising, depreciation, those are all the same. So I have my net operating income. And if you'll remember, simple rate of return is the net operating income divided by the initial investment. So, and this one is a percent, and you need to round it to 2 decimal places. So my simple rate of return is 7.94.